When a client comes to us with big goals, like leaving $1 million to their favorite charity, the question is usually not, can they do it, but how can they do it well? Today we're going to be talking about a situation where a client did just that. Let's chat. My name is Gina DiGirolamo. I'm here today with Cody Vanderhagen. Cody, thanks for joining me.
Happy to be here.
We're going to be talking about a client case study, someone that you've recently worked with, and we're going to be sharing how they gave a meaningful gift to charity. So if you could start and just tee up the client situation.
Yeah, so we're working with a married couple, both recently retired. The husband's age 66 and the wife's age 60, and they have about $7 million in assets, 5 of which are in IRAs, 1.5 in taxable accounts, and then about $500,000 in Roth IRAs. And they currently take $20,000 a month from their taxable account for their living expenses.
And what was their big goal?
So they wanted to give a $1 million donation to their local church.
And why not just have them write a check?
So they could write a check, but they'd be leaving a lot of tax efficiency on the table.
So what did you recommend instead?
Yeah, so we structured the donation, the charitable gift, as 60% highly appreciated stock and 40% cash, which we raised from selling taxable assets.
So let's talk about the highly appreciated stock. Why would that be a recommendation for a charitable gift?
Yep. So when you give highly appreciated stock, you don't have to pay capital gains tax. So you can essentially avoid a large capital gains bill end of the year. And secondly, you get the full fair market value deduction on any of those assets.
So let's talk more about the highly appreciated stock. Why would you recommend that when it comes to charitable gifts?
Yeah. So 2 main reasons. The first one is to avoid capital gains tax. So when you just gift highly appreciated stock, you don't have to worry about paying the capital gains tax. Mm-hmm. And based on where you fall in tax brackets, you could save anywhere from 15 to 20%, which could result in this case with a $600,000 donation, highly appreciated stock, anywhere from $90,000 to $120,000 worth at the end of the year on your tax bill. Mm-hmm. The second reason is you get the full fair market value deduction on any of those assets that you give.
So let's talk about the deductions. How does that work when it comes to stock versus cash deduction?
Yep, so this can be a little bit complicated, but just think of it from the highly appreciated stock and the cash. So when you gift highly appreciated stock, you can deduct up to 30% of your AGI or adjusted gross income, and on cash, so raising cash from assets that we're selling, you can deduct up to 60% of your AGI or adjusted gross income. So for example, if someone has $100,000 of adjusted gross income for that year, if they gift cash, they can deduct up to $60,000 if they make $60,000 donation in cash.
Sure.
And the same with highly appreciated stock, but it's only up to $30,000 if they gift $30,000 of highly appreciated stock. It's also important to note that any unused deductions in year 1 can be carried forward for up to 5 years. So you can do the gift in 2026. That doesn't count as year 1, that's more like year 0. So then any unused deductions can be used year 1, 2027, and so on all the way through 2031.
Okay. So we've done a lot of content in the past on this, but donor advised funds is typically what folks think of when they think about making meaningful charitable gifts. Why not recommend a DAF in this situation?
So donor advised funds are great only if they align with your goals. So in this case, they knew exactly where they wanted to gift the donation, which is to their local church. And second, they wanted to use the deduction over 5 years. And when you use a donor advised fund, any money that's put into the donor advised fund, you get that deduction up front, where that didn't work out best for this client in particular.
Sure. So you mentioned that these folks are retired. They are taking distributions from a non-qualified account for their living expenses. How did this big charitable gift impact their income planning?
Yeah, so this is where planning really became important here. So they're currently taking $20,000 a month from their non-qualified account, like you mentioned. But in order to utilize a deduction, you have to recognize ordinary income. Mm-hmm. And so one thing that we recommended was switching their monthly distributions from their non-qualified account to their IRAs. So instead of sending $20,000 from there, we're sending $20,000 net from an IRA per month. That way we're generating ordinary income month over month, and at the end of the year they have income that they can offset with the deduction that we raise from the charitable gift.
Oftentimes when people are early in retirement, Roth conversions is a big piece of the planning that we're doing. Is that applicable in this situation, doing Roth conversions?
Yeah, there's definitely an opportunity for these clients to do a Roth conversion. So kind of looking back, they generated ordinary income and they were able to offset a lot of that with this charitable deduction. So they're kind of back at square one where now in retirement, income is still low after the deductions. We can still get them up to the 22-24% tax bracket and do Roth conversions for three main reasons. One, reduce future RMDs. Two, reduce your lifetime tax liability. And three, recharacterize the balance sheet for your future beneficiaries.
So as part of this Roth conversion planning, we also have to take into account the fact that we may potentially be adding higher Medicare premiums by adding in this new income. So can you talk a little bit about how Medicare premiums might be affected there?
Yeah, so that's one trade-off that you experience when doing Roth conversions. But in the grand scheme of things, I do think the long-term benefits do outweigh the short-term costs.
Sure. So we talked about a lot of different things today. If you could give a couple key takeaways, or if someone listening wants to do a big charitable gift, what are some things that they should be thinking about?
Yeah, so when you're making a charitable gift or donation, it's not just about generosity, it's about strategy. And there's key questions you want to ask yourself up front. What assets am I giving? How do I maximize tax efficiency? And how does this fit into my broader financial plan?
And it's important to work with an advisor to put together that comprehensive plan that includes things like the income planning that we talked about along with the charitable giving. If you are charitably inclined and want to take a look and see if a strategy like this would fit into your financial plan, reach out to our team at Blue Chip Partners. We'd be happy to help. And it was a great conversation. Thanks so much for joining me, Cody.
Yeah, my pleasure.
Absolutely. And thanks so much for watching. Can't wait to chat again soon.